A day like today really separates the traders with a game plan from the gamblers out there. So let's buckle up because it's time for us to stick to our game plan, the plan that we outlined in Monday's episode, which will not be easy in the face of some sell side pressure. However, we've got to ask and answer the question in today's episode: is it still logical to be a pullback buyer at this level of interest? We'll get into that, but first check out the links listed down below in the description, hit the thumbs up button, and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's kick things off here on our SPY daily time frame chart. What do we see from a trend perspective? We're certainly dealing with a daily trend reversal, the beginning stages, after we've broken out over the neckline of this as a double bottom. Remember that this was the first daily lower high after finally flipping into an hourly uptrend to set the lower high. So being the last high in the trend count sequence, it's of course clear that from here to here, we've got ourselves a higher high. You could make the argument that maybe this is a weekly lower high, but on the daily time frame chart from here to here, undoubtedly a higher high. And thus, it's very reasonable that we can pull back and afford to search for a higher low. And when and if we get that, we would confirm a new daily uptrend. Some folks would already make the argument that this to this is a higher low. This would be the next higher low. I would prefer to wait that extra layer of confirmation after you get the higher high to then look for the higher low. So let's talk about location. Is this an ideal location for the market to find a higher low? Absolutely. It's not only the neckline of the double bottom, so you can get a break, retest, and then continue in the upward direction, but also we remember it as the origin of the breakdown point from back here. Really strong battlegrounds from the bull and bear battle of early August, right? The market just could not make up its mind on the first attempt at the gap from the prior CPI move and also prior resistance and prior resistance. So the point I'm getting at is that there's plenty of market history here around 445, which would make it a severe and really important level of interest. So holding on to it does strike me as structurally important. If we take a look at the candle structure, the actual nature of the bar from today's session, it's not an ideal hammer candle. Of course, it doesn't have a green body. It also does not close back within the previous day's range, but it does have a longer lower wick. About 50% of today's range is lower wick. And what that would imply is just that, number one, either buyers are getting active at this level of interest, which everybody can see. This is not a secret level by any stretch of the imagination. Everybody knows it's there. So either buyers are getting active or shorts just don't want to commit new money short volume down at those lows. Even for a second, if you're not overly bullish on this, let's think about this from the perspective of a seller. If you're a seller getting active after the morning breakdown, right, in the afternoon session, basically looking for the lower high to be set intraday, then you, of course, do not want to see a 50% retracement, never mind a close at the 50% retracement. You want to see a close in the lower third of the range or even just underneath the key level of interest at 445, because technically we absolutely breached it after that first test, right? We did move underneath there and we simply closed above it. We've also closed closer to the expected move. Remember that the expected move is just a suggestion from the options market. It's not as strong as the location itself, but just as an indication, it's certainly a helpful data point on the bull side of the market as opposed to the bear side of the market. We can also note that we've closed right on our daily 50 SMA. Again, stronger sellers, they probably would have wanted to see a break and close below the 50 with strong confirmation at the lows of today's range. It simply did not happen. Now, we did get a gap and go in the first place, so let's talk about that on the hourly time frame chart. Here's the hourly. And what we'll see, of course, is that gap and go. There was no attempt to close the gap overhead, but this is looking much more so like liquidation break. Was it not something that we talked about in the pre-market preps that this as overhead supply could break down? Now, I was certainly not expecting a move to this degree, this far, this fast. That was certainly not the game plan based on Monday's video. The game plan was, hey, manage expectations, but I'm actually glad in a sick and twisted way that the move happened in such a rapid manner. Why? Because it sets up thin structure to the upside, right? Instead of slowly grinding here lower and taking all week to get this pullback to 445, we would have built out structure here that would have been tough to get through. Now that we've got this thin structure, it's 1 hourly bar, no, and even look beyond that, right? Thin structure even to the left. There's nothing here that's basically going to be overly preventative for a move back in the upward direction. So I like it that it's moved so far so fast and sort of outside of the expectations of what we were thinking about from Monday's analysis. But it gets better than that, right? You could take a look at the hourly bar. It's not just the daily bar that fails to get acceptance underneath that 445. It's the hourly bar. When I zoom way in on this thing, you can see it's an hourly hammer. Once again, if there were stronger sellers, why were we unable to close underneath the key daily level? Why didn't we close in the lower 30%? Or even if we got a little bit of a counter trend move, why was there not a weaker move into the close to get us back down underneath 445? So I'm not seeing the stronger evidence that sellers are willing to commit near this strong, important daily level of interest. So how does that ultimately set us up for the move back in the upward direction. The buyers do need to step up and they do need to prove themselves here. Obviously, there is somewhat downside momentum and we need to respect that. However, I think we can be constructive if we open. As of right now, we're trading 30 by 27, 446, 30 by 27 in the post market. So basically right near the close, right? If there's an opening drive lower that catches for support at 445, great. We will treat that as an hourly double bottom, long over the neckline, and you will look to close the gap overhead. That would be your upside rotation. The other thing that could happen is you could get an opening drive lower that technically makes a lower low, but respects 443.25, a sharp reversal back in the upward direction. That's quite aggressive, but if it happens into the end of this week, it's still bullish. Higher low, that sets up your inverted head and shoulders. As long as we are not getting price acceptance underneath 443.25, I think that the trade thesis basically lives on. And again, over that neckline, very thin structure to retrace off to the left. That level, 446.25 roughly. I'll show you that on a 5-minute chart as well in just a moment. So where do the bears have something going on? Clearly, if we get consolidation down here and we cannot produce that higher low for the right shoulder of the inverted head and shoulders over 445, we will concede and definitely be a little bit more bearish on the H pattern that's setting up. If we're just hovering around those lows at 443.25, the nail in the coffin has to be a lower high underneath that level, because then on the daily time frame chart, you're back in no man's land. You're back to chopping around. You're not holding on to basically key structure that would validate the new daily uptrend that's trying to be set based on the double bottom, right? So that's the line in the sand. That's the nail in the coffin to the downside. You could also look for the possibility of a rejection off of 450. I would wait and see what the structure is ultimately to get there in the first place. If we form something that's really solid structurally and does something like this, then of course a stronger pullback off of 450 that holds up over. This is, totally projecting into the future here, but you get the gist, right? An hourly higher low from here to here that sets up an equal high break through 450, that's probably where you get stronger legs in the upward direction. If the market just starts running away to the upside tomorrow morning, you're probably looking for the first higher low pullback to get involved in over an upward sloping VWAP intraday. Here's the 5-minute chart. The only reason I want to show you this is because it does tie into the move straight higher out of the gates. What is this on a 5-minute time frame chart? Certainly inverted head and shoulders. There's your neckline. Lo and behold, it's that same level we've just discussed at 446.25. If the market runs over that, again, first higher low pullback over the neckline, first higher low pullback over an upward sloping VWAP is a logical long entry with tight risk reward to start looking for the closure of the overhead gap. With all of that said, I'll throw on the anchored VWAPs actually, and we'll just go back to the hourly time frame chart. Is there any confluence? There is. I've already looked at it. You know the deal. Here it is, right? There's your anchored VWAP band. If we can clear that neckline, if we can clear that 446.25, that's where you've got some clear sailing up towards the gap close and your anchored VWAP from here. That's your breakout from last Tuesday. And if we stay underneath, again, you're rejecting that anchored VWAP band. We would concede and say, okay, this is bearish consolidation. The threat, the nail in the coffin, is valid underneath 443.25. With that, all that said, let's take a look at some more supporting evidence. Market internals are always Exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. We only have 2 days of data to look at, but do we have any substantial downside reads from a volume perspective? The answer is absolutely not. Even on today's panic sell, we did just get a mild volume outflow read. You'll notice that Tuesday was actually worse. Same thing in the advanced decline line, closer to hovering near trend lower zone on Tuesday when we're just consolidating sideways. And although, yes, we are trending lower today, we were coming from a move initially at or even above the zero line, and it even gets better into the close. So on the aggressive breakdown today, we're not seeing stronger evidence of newer money sellers getting active in this market. Once again, the cumulative build, I would also have to say, was stronger on the Tuesday session. I know that net on the day, it was worse today. However, the sustained build into the close is what matters, right? This initial move speaks to liquidation break, and then nobody else ever wanting to act as a short on today's session at the exchange level. So if anything, this again strikes me as liquidation break from poorly located longs. If I just go back to the hourly chart, poorly located longs stopped out, right? And now stronger longs with better resolve can look to enter on a daily higher low, and that would result in a stronger move in the upward direction. We've shaken out weak-handed longs, liquidation break as confirmed by the market internals, and now we're looking to see if longer-term, stronger longs are going to enter on the daily higher low. Market profile is always Exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. A couple of things to make note of over here. Tuesday did produce a poor low, and we've obviously repaired that with the gap down, violating that in the downward direction. So if we get a gap close overhead, that would be considered done. Complete, finito, all set. In terms of value on today's session, as we're breaking down, I would make the argument that value it didn't really shift aggressively lower with price. If it was, it would be down here. I mean, it's definitely more central, maybe slightly lower from central in the overall profile, but look at the point of control right at the midpoint. The midpoint literally is half back, that purple line, and the yellow line is the point of control. So once again, stronger sellers, they are not really willing to transact at these lows. The other thing that I would point out is that we finally put in good excess at the lows. This is not a poor low on today's session, so the auction ended properly at the bottom. That is exactly what you want to see for a stronger bottom, not something that would have looked like this from the Tuesday session. What else can we point out? We have a string of single prints that's going to be activated over 44.75, and that would roughly be the equivalent of the 446.25 breakout level that we were just talking about over on our S&P. Overall, I think that market profile would align with a stronger bottom being put in place, no evidence of stronger sellers committing and transacting volume at the lows, and if we can breach this, we once again have thin structure to retrace overhead. Jumping back on over to the platform to evaluate the weekly performance of our sectors reveals that energy leads the pack here, up a jaw-dropping 0.01% on the week, basically flat. But that's not really all that concerning when we look at the bottom of the barrel, and industrials, materials, healthcare, utilities are really the ones taking a beating, all down more than 1.25%. If we look at what's lightly pulling back and not as aggressively moving lower, it's your XLY, it's your XLK, it's your XLC, and I don't know about you, but those are definitely the heavier weight risk on sectors for our market. So as this pullback unfolds, it's actually worse in the non-risk on sectors, which is exactly what you want to see as the market's pulling back, basically. So let's look at the structural charts and evaluate what's going on, risk on, risk off. How do the charts look? We know that energy is the concern from the inflation perspective. We also got PMI numbers this morning, which we'll talk about on the fundamental take in just a moment. But if inflation is going to rebound, of course, we want energy to say like, whoa, let's cool off a little bit here. We do have back-to-back inverted hammer / doji. Wouldn't be unreasonable to look for a little bit of a pullback underneath those lows to see if we can breach 90.30 and then turn this into a look above and fail. If that's the case, that would be helpful for the broad market. Remember that it's a lightweight sector, and it would also be an implication that inflation may actually tame itself down just a little bit, undo whatever damage has already been done. Let's take a look at industrials. What's going on over here? Not much to write home about. It certainly did produce a weekly lower high with this breakdown from the Tuesday and today's Wednesday session getting acceptance in this range. The next watch is if it breaks down underneath 105.35, a much more substantial drag for the market. Remember, when we make new lower lows, that's when the lighter weight sectors actually have a bigger impact on the broad market. So we'll keep an eye on 105.35. If that were to break, the next major target would be down here. That's a rough eyeball. I'll get you the level for next video, 103 roughly on the deeper pullback. Just consolidating in here. If it can just cool off, that would be helpful. Let's take a look at the XLB, what's going on with materials, pullback, possibility for a higher low. These charts look much more so like the small caps. We'll talk about IWM in just a second. If this is going to get a higher low, it's got to hold here. We got to stay above 82. Otherwise, you're back down in chop zone once again. Because this is a lightweight sector, it will only become more meaningful when we actually produce the lower low underneath roughly 80.10 or so. Let's take a look at the XLV healthcare sector, second heaviest weight by market cap, but as we know, D for defensive as well. This is worth talking about, right? The breakdown in here is substantial. If this is a D for defensive sector, that's great that it's breaking down, but we don't want it falling off of a cliff. This is always the gentle balance that we have to try to juggle, right? So great that it broke down from a defensive and posturing perspective. However, because it's heavyweight for the S&P, let's see it cool down. Let's see it actually just find some support at 130.25, and that would be acceptable. So we do have that same structure, hammer structure, longer lower wick, buyers trying to step up. It wouldn't seem to me that after this breakdown, basically from the highs to a brand new lower low, the market just wants to continue and break down through prior structure. At some point, it looks like we're trying to find support, and with this lower wick in place, that could be into the remainder of this week. So ideally, this consolidates and goes sideways in this range down here, and that would act as a neutral force for the market. Let's take a look at the XLU for utilities, the most D for defensive sector because of the yield, right? Also pretty lightweight in the grand scheme of things. Moving lower, falling off of a cliff, bear flag breakdown, just totally ugly look over in utilities. You would think to yourself, if there were really stronger fears of recession out there, this chart would not look like this. This chart would be starting to outperform. People would be like, okay, I'm going to go chase my dividend yield. It's just not the case. So I'm not really seeing the argument from that perspective. We know that a lot of inflation data comes out next week. Again, we'll get to that in the fundamental roundup in just a moment. But for utilities, even if there's a counter trend relief move, it's not exhibiting leadership. If any, like upward pressure is upward pressure. Let it see a counter trend move and look for a lower high at 63.10 if the downtrend is going to continue, right? Let's take a look at real estate, really lightweight sector, obviously very rate sensitive right now, just back in the midpoint of this range, not a lot to write home about over there. XLF, fairly pleased with the attempt on a green-bodied hammer today, closing back above after breaching our level here at 34.20. As long as this can continue to hold up over that, this, as we know, was the weekly higher low. Now we want the daily higher low sequence to do this over time and work its way towards the equal high around 35.70 to be more of a risk-on indication for our broad market. It's constructive, but it still has work to do. Still has work to do with just a hammer. It has not confirmed with a break up and over the top. Here's the XLP, also a classically D for defensive sector. Very similar comments as to what we just discussed over in utilities. Is it oversold? Maybe. If it does see a counter trend rally, is it exhibiting leadership? Absolutely not. Doesn't look like risk off is dominating the posture of the market right now. Upward pressure would be upward pressure. Here's the XLY. Here's where we get into some pretty decent looks, right? If this is a double bottom, where's your neckline? There it is. What do we have? Hammer candle. Back-to-back hammers, as a matter of fact. We did not aggressively break down. This has been a mild pullback in discretionary. So as long as this holds up over 167.25, this is looking like a really constructive daily reversal for a higher low here in continuation, back up towards the equal high. And being a heavier weight risk-on sector, that strikes me as more of a bullish than bearish look. Similar comment over here on the XLK. Once again, this as an inverted head and shoulders, totally on the table and in play. Over the top of the breakdown bar from NVIDIA's earnings. A little bit of a pullback. It's very mild in here. Notice that we have basically like a majority of the day overlapping the Tuesday range in there. And even at that, the lower wick is above the 50 SMA. It's above the top of the breakdown bar from in there. So everything that I'm seeing in the heavier weight risk on sectors looks much more so like a mild and controlled pullback, not a big deterioration of the overall trend. From a weekly perspective, you would have to argue that this is building out a neutral trend up here. Like these is getting very close to an equal high up towards the top, right? So if the weekly is neutral and the daily is starting to find a new reversal back in the upward direction, that does strike me as bullish in the short term. Let's take a look at the XLC. Same idea, same comments, rinse and repeat. There you go. There's your double bottom. There's your neckline, 50 SMA, prior structure, 66.75. As long as we're above it, if we can resolve the hammer candles in all, basically if we can resolve the hammers in these three heavyweight sectors plus the XLF tomorrow, doesn't matter what the rest of the sectors are doing, probably going to see a green day on a rebound for your S&P 500. So watching very closely, primarily the big three, XLY, XLK, XLC. If we take out these sector hammers, looking for an up move into the end of this week. Overall, risk on is still the primary outlook, with risk off really struggling in the background, basically. Here's the sector ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. For the most part, I think that we want to align with a risk on revival look. You can clearly see that the XLK heaviest weight risk on cohort is up and over its 50 SMA. Clearly, some relative strength over the past little bit as the market has been making this move in the upward direction over the double bottom neckline. The XLV from a risk off perspective is underneath a 50 SMA, so no longer a threat over here. But the reason we would call it a revival is because we're not all the way there yet for risk on, right? The XLF wants to get up and over what is now an upward sloping 50 SMA. So I'll give a little bit of credit where credit is due, but ideally the ratio is also higher. And the XLY, you can clearly see that there's still an opportunity for some sort of lower high here. You would want to break that resistance trend line before more firmly falling into the risk on category. The XLC also wants to find a higher high. It doesn't really have the threat of a lower high. It's much more sideways in this overall range. So on the cusp of a full-blown risk on look, with the big revival coming from the tech sector over here. In terms of risk off, it's off. XLP is not a threat. XLU is not a threat. Energy, as we know, is a threat from a inflation perspective, but we'll talk about that when we get to the CPI numbers in a moment. And real estate is also not really a threat at this point in time. If we look at some specialized ratios, certainly the XLK is far more the favorite than the XLU. I mean, look at the ratio here making a substantial new higher high. That speaks to risk on all day long, right? And certainly after a higher high, we know that we can afford a higher low pullback. So even if the market does consolidate a little bit more towards that 445 and this ratio pulls back as possibly utilities get a dead cat bounce counter trend move, it wouldn't really jeopardize the trend of this particular ratio. We can also look at something like the XLY over the XLP. This is consumer discretionary versus staples, and you can see that discretionary is the favor here, making an equal high. And this is not quite as bullish as the one that we just looked at between tech and utilities, but if we could pull back, now that we at least have the equal high, ideally a higher low over the midpoint of that range and the prior rejection points from in here, here, and here, that would be more constructive on a close proximity reattempt to the equal high for a break to a higher high. which I know that's very wordy, but that would certainly be constructive for the risk on look in this marketplace. All right, time to make some concessions because it's not all rainbows and butterflies out there. If we take a look at the dollar, which keep in mind, S&P price action is king. This is a tertiary supporting data point, right? But if we look at the dollar, it did move in the upward direction and it did produce a new higher high. So it's totally logical that the market has pulled back as the dollar has drifted for a higher high. But it begs the question, are we going to get that double top anymore, which would be a more substantial reversal in the dollar? Probably not. The odds of that have certainly diminished. So is it reasonable that we could get a pullback? Yes. Is it a stronger trend reversal? Probably not. And certainly a higher low this time anywhere above 103.50 continues the trend. And ideally the target is for the full look below and fail to hit the top of the range at 105.65. So in the short term, if we do get a pullback from this higher high, it would support the thesis that the S&P equities could move higher. But how long that ultimately lasts is in question here based on the dollar and the trend of producing a brand new higher high. What does the gold contract have to say about this? Because gold has, it's been a little interesting here around the retest of the 1950. Not really a great hold, right? Not even a hold by any stretch of the imagination. We've closed underneath on today's session, which again supports the idea that yes, I guess it's valid that the dollar is moving in the upward direction. So as long as gold is under 1950, just keep in mind that the upward move out of equities, it may be very short-lived. We're still looking for the bounce off of that key level of support based on all the daily and hourly analysis that we just did. The structure is there, right? So we're looking for that, but if it's sustained is a different question to be thinking about. And something that also ties into this is going and taking a look at the 10-year. The 10-year has moved in the upward direction. Could we get an equal high pullback? Again, the answer is yes, it's possible. But is this sustainable, right? How sustainable is the move higher in equities, right? This is certainly an uptrend. If we get an equal high and then a higher low, equal high again in short proximity of time, odds increase for a breakout, right? That would certainly put downward pressure on equities over here, impacting greatly the tech sector. So the TNX as the 10-year interest rate, just purely from a technical perspective, looks good for a move at least to the equal high, basically a continuation in the upward direction, maybe a little reprieve on an equal high pullback, but after a higher low, from here to here, we're sort of looking for the sequence to continue, ushering in a higher high. And as a general reminder, that certainly would not be helpful for the market because that's the highest rate that we would have seen in the 10-year throughout the entirety of this hiking campaign from the Fed. So what does the ZT inverted have to say about all this? Is it likely that the Fed will raise rates one more time? Well, this is certainly moving back towards that high, and if we break out over that, that would certainly be an indication that yes, maybe there's one more rate hike in the chamber from the Fed. And we know that the primary driver of that could be something like oil. We saw it in the XLE sector, but crude is certainly moving aggressively in the upward direction. Let's just take a look at that now. I mean, look at this big breakout. We certainly exceeded the local high from in here. It would be sort of unreasonable to not think that crude is going to play a role in the inflation prints as we go forward. So watching that very closely, but let's take a look at the tracker tool and make sense of CPI for next week. The tracker tool is still showing higher probabilities of the prolonged pause that we've been discussing, and that's in total alignment with the inverted ZT that we were just looking at, not making a new higher high for a rate hike, but also not making a new lower low for a rate cut. Remember that a rate cut at this point would probably be an indication that something is breaking out there in the market. The next major watch is where do we see the higher odds of a secondary hike being priced in? Is it going to be the December timeframe or the November timeframe? And to me, this is really going to boil down to the inflation data that we're about to get next Wednesday at 8:30. Here's the economic calendar. Today we got services PMI. Let's talk about this first because services, as we know, is the sticky side of inflation. And PMI reads are either over or under 50. Over 50 is expansion, under 50 is contraction, right? So not only were we expanding over 50, but we blew out the expectation, 54.50 versus 52.50. So that does not bode well for services inflation continuing to move in the downward direction, which is kind of an issue. As we know, we will be getting CPIs and PPIs next week, again, Wednesday at 8:30. This is the big watch. This is ultimately going to determine when and if Jerome Powell schedules a secondary rate hike into the end of this year. Remember the quote that he said earlier, that quote, 2 months does not make a trend. Basically, 2 reads does not make a trend. As of right now, we got a higher read in the month of August versus what we had in July. That would be number one. Second read could possibly be what we start getting in the September timeframe. So it's something to keep an eye on if we continue to trend in the upward direction. If inflation comes in hotter than the expectations and higher than preceding months, that's where I would be willing to bet that yes, Jerome Powell will be data dependent as he's vocally said and add in that secondary rate hike. The market will start to price that in. If inflation numbers remain stable and we actually get a downtick, it doesn't necessarily have to be lower than July, but it should be lower than August. That's much more neutral and I would say aligns beautifully swiftly with just the prolonged pause as of right now. Remember that as inflation starts to come down, as long as his terminal rate remains stable, technically real rates, the effective rate, would be moving in the upward direction. When inflation comes down, it sort of does his job for him to make the higher rates more potent than they might actually seem. What about the risk appetite for our market? Notice that the TLT ratio to the S&P just produced a brand new lower low. This certainly does not look like a flight to safety and would speak to strong risk appetite for equities down below. That, of course, is a bullish relationship. If that relationship is broken, though, we can take a look at short-dated bonds in relationship to one another, and this actually falls more so into the category of something like the dollar, where it's like, okay, this is not really ideal, right? We wanted to see lower lows. That's a higher low. We wanted to see a lower low. That's a higher low. This one made an equal low, but notice that most of them are looking for an equal high. It just speaks to uncertainty further out in terms of time frame, which is not great for the longer duration asset, which of course would be equities down below. So this isn't fantastic, but remember, it's one data point. I would still argue that the structure in the S&P will rule all. Price action in the S&P will always rule all, but this is one more tarnishing data point, if you will. We could take a look at credit spreads. Are these moving in the right direction? I would say yes, for the most part. We did produce our lower lows, so we're good to go from that perspective, and now we're looking for the lower high. As long as they're moving in the downward direction or trending in the downward direction, that would speak to a better environment for equities down below. And then we can look at the HYG in isolation. This is actually fairly tricky. Remember that this is, first of all, way out of sync, right? This high and this high, not even close. This compared to this down here, so out of sync from that perspective. However, we didn't even hold the neckline, didn't even attempt to hold the neckline of the double bottom here over in the HYG. It just begs the question, why was that not the case? So a little bit concerned over here. One more tarnishing data point for our S&P higher low thesis. This might say, okay, maybe if this sees a counter trend rally, it means that you get that breakout sort of move that you've been looking for in the S&P, but like the dollar, how long is it sustained for if we find a lower high in the HYG, and then you get some sort of very clear head and shoulders, right? And that breaks down, certainly putting more downward pressure on equities over here. So something to consider is that these tarnishing data points, it's not the end of the world if we can see a counter trend move, but how sustained is the move in equities becomes the sort of thing. That's what's in question, the duration of the move in the upward direction. Let's take a look at the Bitcoin chart just for laughs over here. It's really stable. It's actually not doing much. It's really sideways, and overall that would be sort of a neutral data point for risk appetite down below in equities. Market breadth, unfortunately, also falls into the tarnishing category, with new highs versus lows making a negative impression underneath the zero line. It did not take out the prior low, though, so hanging on to that as somewhat of a saving grace. If we do move underneath that low, that would be a big-time red flag for the broad market. Remember that in the early stages of trend recovery, it doesn't necessarily have to be producing big-time reads up here. We just need to, by definition, avoid big lower impressions in new highs versus lows. So watching very closely the prior low in there, that's roughly around 75, negative 75, excuse me. If we're under that, bigger red flag from a breadth perspective. If we take a look at the SPX A200R, we're right back down at the 50% mark. So once again, I would be more concerned if we take out that low, but this is certainly a threat, right? It would be irresponsible to say that it's not a threat. It's not a great look. Ideally, this would have pushed away from the 50% mark in this week's worth of trade. It's not the case. And perhaps the most concerning is the SPX A50R, clearly rejecting the 50% mark, moving back down towards the equal low. Again, if it flushes that equal low, bigger red flag, but currently a pretty big deal as it stands with the lower high underneath 50%. Ideally, if the market was going to see a stronger recovery, and if this was a mild pullback, you would have seen more stocks actually recover their 50 SMA on this move in the upward direction. It's just simply not the case, being underneath. So watching that very closely, but more importantly, new highs versus lows is the primary data point to be thinking about from a breadth perspective. Here's the RSP. This is still technically trying to find a higher low over the double bottom neckline, but notice that it's underneath the prior high. So what's the data point here to watch? If we do see a rebound and the RSP produces a lower high underneath 150 on any rally attempt, big red flag, and once again, probably speaks to a non-sustainable move in the upward direction out of equities over here. So as we dive through some of these breadth and even some of the risk appetite charts, we can start to see that duration of a move in the upward direction really starts to become the issue, not whether or not one can happen in the first place. Looking at the Dow, this is actually worth talking about today because clearly we made a lower low in transports versus the attempt for a higher low in industrials. And this divergence down below would speak to, okay, once again, a tarnishing data point for the S&P and just the broad market and equities as a whole to continue to move in the upward direction off of a reasonable pullback, right? No longer is this ready to do something like that. We've just produced a lower low in transports. No good. So divergent from that perspective, again, price action will rule all in the S&P. This is all supporting evidence. It just is a subtle reminder in the back of your head to say, hey, if the move in the upward direction kind of fails, maybe these are some of the reasons why. VIX volatility, a totally normal and to be expected move in the context of a market pullback that's been unfolding over the last couple of days. Specifically on today's session, notice the rejection in the upper wick. It's an inverted hammer if I zoom in on that at the 15 handle. And even for those who say that the VIX is broken, we know that we can take a look at the VVIX and just make note that yes, we are off of the lows, but are we even close to our major inflection point up and over 103? Absolutely not. We're more so centralized inside of this range, which is actually more healthy for the market as opposed to being really, really suppressed down on those 75 lows, which opens us up, as we know, to the complacency effect. Let's take a look at VIX futures. These did move closer towards a backwardation as this pullback has unfolded, but once again, backwardation requires being over the zero line, just not even close. So yeah, is there some concern from a volatility perspective? Yes, but are we close to like this big threat for the market? No. You could even see that reflected in the 9 versus 30-day VIX over here underneath the zero line, and even if we start tracking our support trend line, we actually made some lower lows on the 1-day VIX. So not really overly concerned from a volatility perspective. I think that the breadth indications are the primary threat to the sustained move in the upward direction if there is a threat at all. QQQ daily time frame chart. What do we see here from a candle structure, location, and trend perspective? It's a rinse and repeat of our S&P 500, basically, with the daily double bottom kicking off the start of a trend reversal, producing a higher high. We're pulling back from the higher high. We've got ourselves a hammer-esque style candle, and the lower wick of it is testing our key level around 372, the neckline of the double bottom, the origin of the breakdown, prior support, gap from CPI, prior resistance, 50 SMA is there as well, and we also have the lower bound of this week's expected move. Notice that we did not breach the 50 SMA, we did not breach the lower bound of the expected move, we did not breach the key level here over in the QQQ. So a little bit of relative strength from that perspective. I would have to answer that with an absolutely yes. And if we take a look at the hourly time frame chart, is the setup a little bit cleaner? I would say it might not be cleaner, but it's probably going to happen sooner rather than later, right? There's two things that can unfold here. It's this very similar concept where if we breach here, you're waiting for a higher low back within range, and now we're certainly dealing with a look below and fail on the range. The target's always the top. So a higher low over 375.75, target 379.50. If we move in the downward direction, another test of 372, it's the same idea as looking for the long in the S&P. Can we get a hammer candle down here? Can we get an hourly double bottom? Can we get some sort of inverted head and shoulders on a closer test of 372? It would also be respecting your daily 50 SMA. So I think that you're going to get something one way or another on tomorrow's session for our QQQ, whereas the S&P, as we saw earlier, might take a little bit more time to actually unfold. 372 lower highs underneath are dangerous for the QQQ as compared to the S&P underneath 445. We know that it's really that level underneath, the 443.25, I believe was the number. Don't hold me to that one, but it's that lower high. It's the Monday high, right? You can see clearly that there's thin structure in the QQQ side of things if we actually produce the lower high under 372, and the market's going to fall down in a more substantial fashion. Let's take a look at our anchored view apps. Are these aligning with or contradicting our analysis? I would say that they align. If we do see a deeper pullback, these will slowly get there over time. You're looking for support at 372. If we break higher first, waiting for a higher low back within range confirms the look below and fail and the recapture of your anchored view app from the breakout of Tuesday of last week. Let's take a look at the market internals for the Nasdaq side of things. Very similar comments. Today was actually worse on the Nasdaq, which actually makes sense as compared to what we were talking about over on the ES. Internals were worse on the NYSE on Tuesday versus Wednesday. This makes more sense seeing a larger downdraft on today's session out of the tech sector, primarily driven by Apple, which we'll get to in just a second. This did not get and stay inside of trend lower zone, though. And if we take a look at the cumulative ticks, it does sustain into the close a little bit more so than our S&P and the NYSE side of things, but it's also not like just a straight slope like this. You can see that there's that little wedge in here that's missing. So, again, it's a little bit of a stronger downside move over here in the NASDAQ side of things, but location-wise, as we saw on the daily or even the hourly is fine, right? We didn't actually puncture some of that key support that we're looking to hold on to. So I think that the hopes are here more so on the QQQ for something to happen sooner rather than later, much more so than the S&P side of things. And if we take a look at the market profile, one of the things that I would carry forward here is that we actually produced a poor low on today's session in the NQ versus the ES, which put in great excess. So if this auction did not end properly over on the NQ side of things, and we need to repair that, it wouldn't really be all that far-fetched to see the NQ break down underneath the prior low of day. If we just go back on over to Thinkorswim, that would be something that does this. That would be repairing the poor low and then looking for the support at 372. So the market profile is sort of informing us, oops, sorry for the flip back and forth. It's informing us that it's okay to repair that low, to move lower first, and then still be looking for that support. What you would want to watch is, can we get acceptance after we sweep the poor low? Can we come back into that range and produce a higher low? That would be a higher low after respecting 372 over on the QQQ. Your entry would be here or through the equal high breakout. We also have thin structure overhead through the single prints of today's session. That's going to be over 15,420. IWM Russell 2000 and the small caps, rusty if you will, they're actually looking, well, quite rusty. And the reason being is that we're well extended through the lower bound of this week's expected move. There's no hammer-esque style bar. You'll notice in the upper wick, it's clearly a rejection after attempting to move into the Tuesday's range. And again, we close underneath this key structure here from prior resistance off in the past. So it begs the question, if the broad market's going to move higher, you probably need the support of all three broad market indexes. And to see the Russell lagging like this underneath its key component at 188.25, not really the best look. There's a major divergence between the indexes from that perspective, with the Russell being the major laggard at this point in time. The one thing that it might have going for it is there's still technically, we're stretching it a little bit here, there's still technically the possibility for a higher low over 188 from here to here. It's not ideal, but it technically could be in play as long as we stay outside of this as prior bear flag consolidation range. Obviously, the threat going forward, though, is that any consolidation here that cannot get up and over 188 puts more downward pressure for this really ugly, I know it's sort of in the wrong part of the trend sequence, but a head and shoulders, which would get you to the neckline of this as a head and shoulders. And keep in mind, great, that pattern's, it's certainly valid, but only when and if we break down underneath the neckline to usher in some sort of new lower low. That would be underneath 183. So a little bit of work to do from the sellers if the head and shoulders is going to play out, but so far, that looks to be the threat as long as we're underneath 188.25. The buyers, you got to get it up and over 188.25 and then produce some sort of higher low. That needs to be the case. Otherwise, we're feeling very, very cautious and neutral about IWM and its impact for the broad market. If we do get over 188.25, the target's quite clear. It's the high of last week, 191.25. Let's take a look at the hourly time frame chart. Anything else to glean from this? Not really, other than once again, it's been absolutely hammered this week. We had something that was looking like a fairly sustainable uptrend with higher lows being produced, nice push and pull, and just completely wiped away. So we have retraced some of the thin structure primarily from the Tuesday breakout of last week, and we'll see if we can stay outside of the bear flag consolidation range. Maybe a little bit of an easier visual here on the hourly time frame chart for 185. Reason to act as support, right? Resistance, look above and fail. When we broke, it held as support on the first test, which would have been right here that Tuesday when the thin structure was unfolding in the first place. One thing about this that does strike me as interesting is that all of the damage is done in the initial stages of the day, and then maybe there's a mild trickle lower. All of the damage is done early on, and then there's a trickle higher. So this is much more so long liquidation, not sustained selling pressure throughout the course of the day. And that would just tell us that, okay, technically that indication would be longs from up here are closing out as we moved underneath the 188.25. Not necessarily that stronger new money sellers are technically getting involved. New money sellers, there's give and take, right? We've talked about this concept in the past. That's certainly not what the indication is there on the hourly time frame chart. In terms of new money sellers as well, here's the market internals for the Russell. Nowhere close to trend lower zone in terms of volume. Trend lower zone on the Tuesday session, but today, fairly mild, coming from above zero, getting underneath zero. We'll give credit where credit is due. It's definitely more bearish than bullish, but not to the degree of new money sellers. And the same concept with our flattened cumulative tick into the close. It's all the damage in the beginning, and then nobody wants to participate in the afternoon. Long liquidation seems to be the name of the game right now in the Russell. When and if it turns into sustained selling pressure, that's where we're probably more concerned for our broad market as a whole. Here is the market profile, and once again, B-shaped profiles back to back. What does a B-shaped profile tell you about the market? Once again, long liquidation. Emotional panic in the morning. Nobody else wants to commit new money shorts in the afternoon. Same thing here on today's session. If you've made it to this point in tonight's analysis, I appreciate you coming out to the late night episode. If you know the keyword, drop it down below in the comments section. If you're a new viewer to the channel, go ahead and look out for something that involves an animal emoji and maybe a moon emoji. That'll be your hint for what the keyword is, the special keyword for a late night episode. Pretty self-explanatory, actually. But For the most part, what's going on with Apple? Core list of companies. What do we see here from a price action perspective? Solid red-bodied bar. Devastating move for Apple on today's session, but easy come, easy go. Thin structure was retraced, and now we find ourselves back at the breakout point from this as a daily inverted head and shoulders. So is this the ideal location for a new money short? Probably not. You're chasing it at this point in time. The move has ultimately unfolded, and you're shorting into an area of potential support. What was once resistance now has the opportunity to act as support around 180. So I'd be very cautious trying to play shorts in Apple here. Let's take a look at the hourly time frame chart just to illustrate it's a straight shot lower, right? There's no reprieve at any point in the day from Apple. So there's definitely some solid downside momentum. It's not an easy long either. Let me be very clear about that. Just because something's not a short does not mean that it is a long. To see a long unfold in Apple, I'd probably want to see the inverted head and shoulders case very similar to S&Ps that produce something like this, right? A test of 180. So a little bit of downside continues. All the shorts get suckered in, right? And then a higher low back above this level right here over the neckline. Again, easy come, easy go. Easy come for the shorts, easy go for the shorts. We would start to retrace through that thin structure closer towards 187.75. Notice that there's hardly any interaction here intraday at the 185. Maybe a little bit of a back test there after the first hourly bar, but not much, not much. So that's your ups and downs for Apple. I would not be chasing this in the downward direction if we're just trading around in this choppy range from the prior balance in the past. Let's take a look at Netflix. This is still an hourly time frame chart. It was looking constructive with the bull flag consolidation inside of the overhead gap range as we headed into today's session. Unfortunately, obviously, we fell out of that. So the look now is if we reject underneath 448.25, if we can break this as a neckline, fill the triangle, and you're looking for a retest of this level at 436.75. That's if we continue to rally first, if we find ourselves opening towards that level in the first place. If we open towards the lows, your risk reward is no longer as favorable, right? It's better to get a short up here with risk reward that looks like that versus trying to short this to this with a stop, arbitrarily. Maybe if you've got a 5-minute level of interest, that's cool, but the distance to travel is just not all the way there. So if anything, and we open here, I wouldn't be thrilled about the short outcome. I would just be content for sideways consolidation and ultimately wait for the next move out of Netflix, either a test back up here or some sort of breakdown to get back inside of this range in the past. Next up is Tesla. And just like Apple, easy come, easy go, this is a great illustration, right? Easy come, easy go, easy come, easy go. This has just been all over the place. Here's the daily time frame chart. The main point I want to illustrate here is that we've got candles with same size bodies stacking up. We've got a hammer candle. It's technically an inside bar. At this point, because you guys know this if you've tuned into the pre-market prep, I was wrong about the Tesla break over here. We were thinking about rejections underneath the overhead supply, right? That's fine. So I don't want to get emotionally invested on the wrong side of Tesla because of the evidence that we have in hand with these wild swings back to back, 100% retracements up, down, sideways, back and forth. I'm going to be patient in Tesla. This is my just announcement to the world. I'm patient until we're over 261 or we're under 242. I don't care how good the opportunity is in between. Tesla has clearly exhibited that it does not want to respect structure that we had here at 251. Let it do its thing. Wait for the move over there. You'll have more confidence. Wait for the move under here. You'll have more confidence. So that's my take on Tesla, announcing it to the world. Call me, whatever you want to call me, but that's my take. Google, head and shoulders, definitely a possibility now that we're re-interacting with 133.65, right? This is the Man Ray pattern as we've been talking about in the pre-market preps. So if this fails, right, that's a pretty big breakdown. That starts to look more so like a look above and fail on the daily time frame chart. Over time target is the bottom 127.65. That would coincide probably with a stronger breakdown across the broad market. If the QQQ is going to hold on to its 372 level of interest, I would be looking out for Google to, again, hold this, and instead it's a higher low over 135 to retarget 137.50. That's the primary look for Google, considering that it is technically outside of the balance, right? This is a more bullish than bearish chart in the first place. Technically, we've breached this as a neckline. We've kind of come into that area of support. We started to find some buyers, again, waiting for the evidence over 135, retrade up towards 137.50. Patient on the shorts, only if the broad market's collapsing under on a lower high confirmation, 133.65. This turns into look above and fail, right? So we've hammered that one home. Metaverse, this one's fairly straightforward. Range trading, 101. Longs over the top for something that does this. Shorts under the bottom for something that does this. The level of interest, 301. It failed on today's session. We find ourselves in the midpoint of this balance range, so it's not bearish yet. But the failure is certainly notable. If we do start interacting with the lows after a failure, right, the most recent interaction, then great. We'll look for a flush underneath the bottom, but still we want this to unfold for the better risk reward. Lower high underneath, 294.50. So 301 and 294.50, those are the major inflection points. NVIDIA, again, falling off of a cliff, very similar to Apple on today's session. Bearish consolidation on the lows. Difficult to be a new money short. However, the risk reward here is actually somewhat okay to trade if we can slip the 464.75. Lower high, trade to the equal lows back here at 454. So downside risk reward is probably better in NVIDIA just because of the distance that we can travel if we can get a tight setup like this and we don't just get a first hourly bar that is straight lower, very difficult to get on board a trend that looks like that, right? So primarily watching downside after this bear flag consolidation, 464.75 lower highs below, 454 becomes the target daily 50 SMA, will slowly meet us there over time. For longs to get something going, you could get a little bit of a squeeze. I would just watch out for 471.25. I'll update that to be 25 right now before I forget and yell about it in tomorrow's stream. So there's 471.25, higher lows above, just like everything else. Thin structure retrace would not be overly bullish, and I would not overstay my welcome on the retest of 480. That would actually be a great short opportunity if we rally first. So if you're not in love with going long NVIDIA, that's fine. Even if we break, look for the short at 480 on the lower high reattempt underneath this prior balance. Next up, we've got Microsoft. What's going on with Softy? Still on that hourly time frame chart, folks. We have not gone back up to the daily. What do we see over here? Certainly trying to be constructive in the upward direction, holding on to this prior rejection where we faded back into the range, right? So next long is over 334.50 with some acceptance today. It didn't really move as low as the broad market or as aggressively in the downward direction as the broad market, which is fairly noteworthy. Next overhead target is going to be the midpoint of this overhead range where we start to get some of these rejections around 340. That would be the upper target, 340 on a break and higher low. That with participation from the broad market, of course, as a whole. Last but certainly not least, Amazon, the mini beast. Some weakness, great rejections underneath 137 on today's session. That has really been a major inflection point that we've been talking about over the past couple of really days, but it was definitely valid from the weekend update as well. So great slip underneath on Tuesday. Lower high was set even on the rally this morning for the drop back towards that 135.50. Again, chasing this on a lower low, not thrilled. I would wait for some sort of lower high or just congestion to build out a micro range on the hourly and then flush that. As long as you've got good risk reward, your next target would be down at 133.75. Let's get along into some 2 additional trade ideas. Honorable mention to our good friend AMZN. It's been a while, my friend, but you can see that we've got an inside bar on today's session as the broad market basically made a lower low, right? So if this wants to take out the equal high here, it's not the cleanest double bottom. You might just make the argument that it's an equal high break. We go to the origin of this breakdown from back here at 115.16, and that breakout is up and over 111.15. If we take a look on the hourly time frame chart, if we can clear the top of that large aggressive breakdown bar, I do think that some short get squeezed out. You might want to wait for a higher low above. That's fine. Whatever tight risk reward you can set up that is over 111.15 to target 115.61, that's looking pretty good for a move to where the breakdown came from in this area in the past. A further target would be closer towards that 119.75 area up here where this breakdown stemmed from, right? So that's AMD. Honorable mention to a long lost friend of ours. Let's take, and not interested, of course, if we're just chopping around inside the inside bar range. It keeps the setup valid if we produce another inside bar. That would be a double II setup, according to Al Brooks, of course. Shout out Al Brooks. And then if we sweep the lows, right, if we get underneath those lows, it's just off the table as a trade setup, right? Next up is SQ, Square. What's going on with SQ? If we need shorts, we're looking at Square. If we need longs, we're looking at AMZN. So Square is a short because it has a bearish engulfing gravestone doji. That's a lot of ways to describe one singular bar, but we open underneath on a gap down, the previous day's range. We rally and take out the previous day's high. And where do we close? All the way back down at the opening print, basically underneath the previous day's low. So if longs had an opportunity to start to squeeze through this thin structure in the past, there was their move. We had a bullish engulfer at one point, and now we have a bearish engulfing gravestone doji. Tons of descriptive words, whatever you want to call it, that's fine. If we can take out the low of the gravestone doji, looking for a move to produce a look above and fail back into this lower bear flag range, and that target would be at 55.30. The slip is underneath 57.50. That's all I've got for you in today's episode of the Midweek Market Update. I appreciate you coming out to the late night show. I will see you tomorrow morning, bright and early, 8:15 in the office for our pre-market prep. And with that said, I wish you a green trading week.